first one, of course, we are going to talk about volume spread analysis. Volume spread analysis, or the VPA, attempts to read the action of the smart money or the strong hands by reading the price action with three parameters, that is close of the price and the spread and the volume. And the basic premises for this VSA is that the market is being manipulated by smart money. In fact, it was in early 1940s, Richard Wyckoff, he promoted this idea, and he called it, of course, the smart money as composite man. So he says that they are sitting behind and manipulating the market to your disadvantage. But if you understand how we place it, you can really take advantage of that. And this is what we are trying to do here. We are trying to understand the move of the smart money and trying to follow them. So, it's like swimming with the sharks. And then, you take your crumbs from the big money or the smart money makes money, you also make your money, your bit of the money. That is the basic idea behind the volume spread analysis. Okay. Now, there are four phases of manipulation, actually. It is like accumulation, markup, distribution, and markdown. Now, if you look at here, there is an accumulation phase where the stock is being accumulated, then the markups phase, and then we have the distribution phase and the markdown phase. And if you look at even the real market, this keeps getting repeated. Here, just an example of Edelweiss, actually. There was an accumulation phase for like multiple years of accumulation. Then there was a markup phase, distribution, and the markdown and the accumulation. In fact, this is one stock which I really benefited. I got into this accumulation phase and sold it at the top during the distribution phase, and I did make good money out of this. So this keeps repeating, this pattern keeps repeating. You can look up any charts, this pattern keeps repeating and repeating, and the idea is to make money from such patterns. Now let's look at in little more details on what is accumulation.
Sir, I have one question here. I have one question. Please go back to the chart.
Yes.
Now my question is that this chart, is it a daily chart? And question number two is, does this work in all time frames? So even if I draw
Yes,
chart, will work in that time frame as well?
Yes, it does work in all time frames. We can later on we can look at different time frames to see if all these indications do work or not.
Sure.
So it is as per the theory, and of course I've seen myself that it works in any time frame. But since I'm a professional trader, I use the EOD charts. This is an EOD chart.
Sure, sir. Sure. Got it, sir.
And most of my work is based on EOD charts, and I make it clear whenever I do release some work, I tell them it's an EOD chart. And of course, people have given me feedback that it does work on lower time frames, even on 5-minute time frames. These indications of the VSA do work. That is the idea. It works on any time frame.
Sure.
Now, accumulation is a slow process of cornering all the stocks without attracting attention. That nobody knows that it is being, accumulated until there is no supply of the stock. There are almost nil or no supply of the stock, and that's the time when the smart money or the people, the strong hands, get ready to mark up the stocks. So normally you see a breakout from a congestion zone or an accumulation zone. Usually the breakout is on high volume. Then the stock moves up in stages. So you know that it is always up and then down, up and down. So the up is on higher volume, and then it comes down on a lower volume. It is the way that the stocks move up and up. We all know that. And during this uptrend itself, there could be some distribution happening. Finally, the markup phase comes to an end. There could be two ways of how it's come to an end. It could be a rapid high volume thrust. I mean, it moves up very rapidly on a very high volume, a buying climax, then the stocks comes down. That means in that last upthrust itself, they have completed the distribution of the stocks, the strong hands as to the weak hands, and then the stocks come down. And most of the times you find a congestion area at the top. That is like, it goes up a lot, and then there is a congestion area where the distribution takes place in a very slow, stealthy manner, and then the drop down or the markdown happens. So distribution is the process where you the strong hands or the big institutions offload their stocks to the weak hands without much noise, and then it is done very stealthily. And so distribution can happen during uptrends, which we will see, or in congestion zones. And it is done in a very stealthy manner, hot to spot, invisible to the weak hands. And then the markdown happens, and this is the most, like a pathetic phase, you can say, where supply overwhelms demand and the prices start tumbling, panic spreads, and finally panic selling happens, and the stocks comes down to the previous level, or at least a much lower level, where the process, the whole process repeats. And there are three laws of Wyckoff, which I will not go into details of this. Our concentration is on the VSA. I will not go into the details of this.
Yeah.
First is the law of demand and supply. Of course, we all know that in any market, leave alone the stock market, it is always the demand and supply which moves the price. When there is a lot of demand and no supply, the prices move up. And there's a lot of supply and no demand, the prices move down. So this is the basic law we are going to look at, and we are all aware of that. And there is also a law of cause and effect, which I will mention wherever I get the chance. And the law of effort and result. This also we will look at later. But these are the basic laws. I will not go into details of this now. Now, let's come to some practical applications of this. So before we go into the practical applications, let's look at some assumptions or basic rules we will create to define our the VSA signs or strength or weakness. Okay, I will just give me a minute. Let me open my. Now, first, some definitions we will make. Now, we are always talking about spread. Now, what is spread? The spread is that, this the typical OHLC bar, this open, high, low, and close bar is there. So the spread is the high minus low. This difference between high and low is the spread.
Sure.
Okay. And we take an average of the spread for the last 60 days, and that will be our average spread. And any spread which is like more than 1.5%, 1.5 times of the average, we call it high.
Okay.
Okay. And which is less than 0.7 of the average, we call it low, or means small spread.
And the average is for how many days? Sorry, you said how many calendar?
60 days. I mean, there's no hard and fast rule. I've like some people use 90 days. I prefer to use 60 days, but because that is 3 months, a quarter, 3 months of trading. 66 days is the trading. So we use it like I use it 60 days. That is the average I take. So there's no hard and fast rule. Somebody wants to use a higher thing, he can use it, like 6 months can be used. But my standard software uses 60 days. And of course, I've given the option to change it as well. So this is a basic definition for spread. Okay. Similarly, we look at the volume. We take the average of the volume of 60 days, and volume more than this 1.5 times the average, we call it high volume, and less than 0.7 times the average, we call it low volume.
Okay.
So this is a basic definition we are putting for ourselves. This is spread and the volume. We have the basic definition. And we need to, in volume spread analysis, the basic thing is they look at only close. Okay, so let me. We need to see where the close is. Now, up close is it is closing in the upper side near the high. We say it up close, and if it is in the middle, we call it the mid close, and if it is in the lower side, we call it the down close. Okay, of course, it could be on the upper side, lower side. We use different terminology, but this is the basic one: is up close, mid close, and down close. These are the basic terminology we use. Okay. And the next one we will see is that now there's one assumptions we are for studying the what is happening in that particular bar. We take the high minus close. We take it as the selling pressure. Okay, and the close minus low we take it as the buying pressure. You see, like when the price is high, if it is only if there is a selling, it will come down, and it just closes here. So we approximate this as the selling pressure. And when it is low, when there is a buying, the price goes up and it closes here. So we approximate it as the buying pressure. So it is an approximation, but it works very well for our purpose. We don't go into much complications. We make it simple. So this is quite good enough to understand the selling and the buying happening on a particular day or in a particular bar. Okay. These are the basic definitions we will. Okay, now I'll go back to my PPT. Okay. Now these are the basic definitions we have done. That is a spread. What is the high spread, low spread, average volume, high volume, low volume, and the close of the bar, up close, mid close, and down close, and how we understand what is selling and what is buying in a particular bar or in a day. Okay, these are the basic assumptions we have done for our practical applications.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.